Welcome back to the Deep Dive. Our whole goal here, as always, is to take these incredibly dense, complex, sometimes really controversial ideas and just, boil them down into what you actually need to know to be informed.
And today we're doing something a little different. We aren't just looking at economic data. We are fundamentally challenging the operating assumptions of modern finance. We're wading right into this territory of, well, is it prophecy or is it mathematics?
That's a huge question.
It is. We're asking something that, every central banker, every government is debating behind closed doors. Is the global economy just random? Is it subject to, let's say, policy errors and political whims, what we'd call stochastic?
Right.
Or is it governed by something else, by immutable, precise, and deterministic laws of oscillation?
That is the central tension we have to get to the bottom of today. We're focusing our forensic lens on what might be one of the most radical deterministic theories ever proposed, Martin Armstrong's economic confidence model.
People might know it by its other name, the pi cycle.
Exactly, the pi cycle. And Armstrong's claim is, it's just audacious. He posits that the collective action of billions of people, the entire global economy, it doesn't just have random recessions.
Oh.
Instead, it breathes. It breathes in this mathematically precise rhythm fixed at a frequency of 8.6 years. And that number is supposedly derived directly from the mathematical constant pi.
It sounds like science fiction, but that's the claim.
It really does. And look, if this model is just some numerological fantasy, it's irrelevant. But if it is a genuine constant, that suggests we're not just facing another recession. It suggests we're on the precipice of a really severe structural transformation.
And the model gives a very grim, very non-negotiable forecast for the critical period between 2025 and 2032.
So our mission for this deep dive is simple, but it has to be rigorous. We're going to do an independent forensic regression test. We're going to look back at 340 years of financial history to figure out if this 8.6-year cycle is a dangerous distraction or a genuine predictive behavioral constant.
And crucially, as we're going to get into, we have to perform a clean separation. We have to look at the cycle's verifiable methodology completely apart from the highly controversial history of the man who developed it.
Okay, let's unpack this. So to really understand the weight of the pi cycle, we have to start with the two sort of warring philosophies of economics. The mainstream thought today, what's taught in every major university, what the Fed relies on, is fundamentally stochastic.
Right, and the stochastic view basically says the economy is manageable, the future is uncertain, sure, but it's controllable. If a recession happens, it's a policy error.
Like hiking interest rates too fast.
Exactly. Or it's an exogenous shock award, an oil crisis, a pandemic. The core belief is that with skilled technocratic adjustments, tweaking monetary policy or fiscal spending, you can smooth out the business cycle. You can avoid the really severe downturns.
But the deterministic, the cyclical view that Armstrong is in, it just rejects that entirely.
Completely. They argue that human economies are complex systems, and complex systems, well, they often operate on fixed laws of oscillation, regardless of what a central bank chairman decides to do on a Tuesday.
And you mentioned this isn't a new idea, right? There's a historical lineage here.
Oh, absolutely. This goes way back. In the 19th century, you had William Jevons. He saw economic fluctuations and famously tried to link them to the 11-year sunspot cycle.
The sunspots, right. The idea was what? That solar radiation affects crops, which affects the economy?
That was the idea. And while that specific link was, largely debunked, the core concept that economies have natural, non-policy-driven frequencies that persisted, then, of course, you get Nikolai Kondratiev.
The K-waves, the long-wave theories.
Right. He mapped those 50 to 60-year long-wave cycles, which he loosely tied to big technological revolutions like steam power or, electrification.
But those cycles were based on something physical technology, biology. Armstrong's claim is much, much more abstract. It's about the mechanism of the cycle itself.
Exactly. Which brings us to how he says he discovered it. The source material is clear. He didn't start with the number pi. He started with just a massive data-heavy analysis of historical fear.
It was pure archival work.
Pure archival work. Starting back in the late 1970s, he just became obsessed with cataloging crises. He compiled what he called a panic list that spanned 224 years, from 1683 all the way up to the Panic of 1907.
And in that period, he identified, 26 distinct crises?
26 distinct, globally relevant financial crises. So he was essentially measuring the time that elapsed between these 26 huge moments when collective human confidence just failed, when greed suddenly collapsed into fear.
And he found a pattern.
He observed that the average time period between these major systemic panics was uncannily consistent. When you take all the days between those 26 crises and you average them out, the number you get is approximately 3,141 days.
And that's the light bulb moment.
Yeah.
3,141, that's where the connection to pi comes in.
That's the aha moment. You divide 3,141 days by the number of days in a year, 365.25, and you land right on 8.6 years. And then the bigger realization, 3,141 is just 1,000 times the first few digits of pi.
3.14159.
Exactly. So Armstrong's theory, his postulation, was that the cycle isn't tied to sunspots or crops. It's a mathematical resonance.
I mean, that suggests something really profound about human psychology, doesn't it? That the swing between our collective greed and our collective fear isn't random. It's literally fixed by a natural constant, almost like it's part of the architecture of time itself.
Like the orbit of a planet or the physics of a pendulum, that's the entire weight of the model. The economy is behaving like a complex harmonic oscillator. And that 8.6-year cycle, 3,141 days, that becomes a foundational business cycle.
And that's what governs things like liquidity, inflation, and how often we see these big panic events.
Correct. But if this is a fractal model, like you said, the 8.6-year cycle is just one layer. It has to scale up and down to explain, smaller market moves and also the collapse of entire empires.
So how does that fractal structure work?
Well, within that 8.6-year base unit, you have smaller subwaves. It's often broken down into, say, 3 waves of 2.15 years each.
And those would govern what? Minor corrections, sector rotations?
Exactly. Or you can see it as 2 waves of 4.3 years, which usually mark a kind of mid-cycle shift. That often determines whether the overall 8.6-year cycle is going to be more inflationary or deflationary in character.
Okay, that adds a lot more granularity. So if the last major peak was in, say, early 2020, then 4.3 years later, in late 2024, we should expect a pretty significant turning point in whatever the dominant trend is.
That's how it's used. It gives you more frequent waypoints. But now let's scale up. If you take 6 of these base cycles, so 6 times 8.6 years, you get the major wave.
Which is 51.6 years.
51.6 years. And this aligns conceptually with the traditional Kondrativ wave.
Right, the 50 to 60-year K wave. But why does Armstrong claim his 51.6-year measure is better or more precise?
Because the K-wave is descriptive. It just says, hey, we see technology cycles seem to last about 50 years. The ECM claims its period is prescriptive. It's mathematically exact. This 51.6-year cycle is meant to track the lifespan of major technological and, more importantly, structural debt cycles.
So an example would be what? The shift from the post-World War II Bretton Woods system to the U.S. coming off the gold standard in 1971.
That's a perfect example. That's a major financial epoch change, and it fits that 51.6-year timing.
Okay, and then there's the really big one, the sweeping historical scale, the supercycle.
Right, the supercycle, calculated as 6 times the major wave, which comes out to 309.6 years. It's also sometimes cited as just 100 times pi, so 314 years. This is the cycle that supposedly tracks the geological shifts of global financial power.
We're talking about the rise and fall of financial capital.
The whole arc. The dominant shifting from, say, Venice to Amsterdam, then to London, and finally to New York. The ECM posits that these massive, once-in-an-era transfers of global financial capital, and even the lifespan of empires, they adhere to this 309.6-year rhythm.
And the source material often uses this to explain things like the fall of the Roman Empire and, crucially for us today, the predicted decline of the U.S. as the global financial hegemon.
That's the big picture forecast, yes.
So, okay, if the pi cycle gives this incredibly precise when for these turning points, how does the model determine the what and the where? How does it know if a cycle turn is going to show up as a collapse in U.S. bonds or, I don't know, a massive surge in Asian stocks?
That brings us to the operational tool, the computer system he developed called Socrates. Socrates is the mechanism that connects this deterministic timing framework to the messy, stochastic reality of market prices. It was developed through the 70s and 80s, and its primary purpose was to overcome what Armstrong saw as the central flaw in mainstream economics.
Which you mentioned earlier, the closed system model.
The closed system model, the idea that, U.S. interest rate policy only affects U.S. inflation, full stop.
Which seems insane in a globalized world.
It is. Socrates completely rejects that isolation. It runs on what he calls the capital flow argument. And the argument is simple. Capital, like energy, cannot be destroyed.
It can only be transferred.
It can only be transferred. If confidence in one asset class or in one entire country collapses, that capital has to go somewhere. It will flow instantaneously to bonds or to gold or to foreign stock markets. It's a zero-sum game on a global scale.
So Socrates is basically a high-speed global temperature gauge. It's tracking all these liquidity movements between different assets, currencies, countries.
That's a great analogy. It takes in a massive amount of data commodities, futures, bonds, stocks, currencies from over 150 countries. It's analyzing volatility, open interest, directional momentum, all of it. And the key output is the identification of reversal points.
And these are the moments where the system predicts capital is about to abruptly change direction.
Exactly. And those reversal points should, in theory, confirm the big shift that's being dictated by the 8.6-year temporal anchor.
So the whole system, its predictive power, it really hinges on two things working in perfect sync. The fixed mathematical timing from pi to when, and then the system's ability to accurately track real-time global panic, the what and the where.
You need both. Without both, the model is either just, numerology on one hand or just reactive market analysis on the other.
Right, and that's exactly why this historical regression test is so critical. We have to see if these pi cycle nodes actually line up with pivotal moments in history, or if this is all just, fitting a neat number to historical noise. Okay, let's put on the skeptic's hat. We're now going to test this claim that a deterministic rhythm has been governing human affairs for centuries. And the whole thesis, it really rests on the accuracy of these anchor points. So let's start at the very beginning, 1683, the supposed year zero.
Right, 1683, the cycle anchor. The event that's cited is the Rye House plot. Now, as we noted, this was a political conspiracy. It was a plot against King Charles II.
So not a market crash.
No, not a market event at all. It was a political event, and it failed. Armstrong anchors the entire cycle here, not because of a panic, but because the failure of the plot led to a massive consolidation of royal power, which fundamentally stabilized the risk profile for capital in London.
Okay, so that confirms the model's definition of confidence. It's political first, then economic. Capital needs a predictable, stable government. If the king is safe, your investments are safer.
That's the idea. The stability that followed that event allowed London to really begin its ascent as the world's financial center, setting the baseline for the next 300 years of English financial dominance. So, our verdict: valid historical anchor rooted in that political stability.
All right, let's move forward one cycle, 8.6 years, to 169-11692. What happened at that first turn?
The consequence was fiscal despair. Britain was deep in the 9 Years' War, and it was financially ruinous. The Treasury was basically insolvent. This led to a widespread loss of confidence in the Crown's ability to pay its debts.
A sovereign debt crisis, essentially.
A 17th century sovereign debt crisis. And this moment of crisis in 1691-92, it forced a radical structural change.
And that change gave us the backbone of modern finance.
It really did. This fiscal collapse led directly to the government passing the Million Act in 1693, and then, even more importantly, the establishment of the Bank of England in 1694. This wasn't a minor policy tweak. This was the birth of a formalized central banking system.
A system created specifically to handle the state's massive war debt.
Precisely. The 8.6-year turn identified the exact moment when the old, unstructured financial system collapsed under pressure and had to be replaced by a new institutional one.
That's a very, very strong hit. And just for context, the source material notes that the height of social anxiety, which included the infamous Salem witch trials, also happened in 1692. It suggests that the financial panic was manifesting as broader societal paranoia.
And that aligns perfectly with the cycle node. So our verdict: high correlation. The crisis was the catalyst for a foundational institution.
Okay, let's scale up. Let's go to the 25.8-year node, 3 times the base cycle, 1071
This point is another huge structural confirmation. This is the year of the Acts of Union, the creation of the Kingdom of Great Britain.
On the surface, that sounds political.
It sounds political, but underneath, it was almost purely economic. Scotland had completely bankrupted itself with the disastrous Darien scheme, their attempt to build a colony in Panama. The Union was, in effect, a massive English bailout of Scotland.
A bailout?
Absolutely. It unified Scotland's national debt with England's and created a single, powerful trade zone. So the cycle didn't predict a market crash, but it accurately predicted the timing of this necessary radical restructuring of state debt and trade systems.
A restructuring that was needed to keep the larger empire solvent.
Exactly. It's tracking the health of the sovereign. Our verdict: strong structural hit.
All right, let's jump forward into the 20th century, where the data is, a lot less contested. Let's look at the 1907 panic. This was a key event in his original panic list.
The panic of 1907, or the banker's panic, was an exact hit on the cycle timing. In October of 1907, a massive liquidity crisis just slammed the New York Stock Exchange. The whole system was so fragile that the only thing that stopped a total collapse was the private intervention of one man.
J.P. Morgan.
J.P. Morgan. He literally locked all the major bankers in his library and refused to let them out until they agreed to pool their money and fund a bailout.
And that crisis of confidence had profound long-term consequences, just like the 1692 crisis.
It did. The 1907 panic was the final straw. It's what convinced Congress that the U.S. couldn't rely on one rich guy's library to save the financial system. We needed a formal, centralized banking structure. 6 years later, the Federal Reserve Act of 1913 was passed.
So, again, the cycle correctly timed the moment the system failed and required a structural replacement.
Yes.
Now, this next one is critical. We have to address the Great Depression. Mainstream history always focuses on the 1929 stock market crash, but the pi cycle analysis points somewhere else. It points to 1932 as the real turning point.
This is, I think, maybe the most important and differentiating insight of the ECM. If you take the prior cycle turn, which was 1924.25, and you add 8.6 years, you get a cycle date of 1932.85.
So the math points squarely to late 1932.
Exactly. And while 1929 was, the spectacular speculative peak, the market and the economy did not bottom out until July 1932.
That was the absolute pit of despair. The Dow had fallen, nearly 90% from its peak?
Yeah.
Banks were failing everywhere. Capital was completely paralyzed.
That's it. The cycle dictates that the most important timing isn't the peak, it's the trough, the point of maximum distortion. Because it's only after you hit maximum distortion that you can get a fundamental resolution. And that 1932 low, that moment of absolute capitulation, directly preceded the election of Franklin D. Roosevelt and the implementation of the Radical New Deal,
which completely restructured American finance and governance for a generation.
So that focus on the low, rather than just the peak crash state, shows the model is tracking something deeper than speculation. It's tracking systemic confidence, our verdict, exact hit on the cycle bottom, and a crucial refinement of historical analysis.
Okay, now let's move into the modern era, the era of ex-ante validation predictions made before the event happened.
Yeah.
This is crucial for getting past the charge that he's just, fitting the data after the fact.
And the most famous example is 1987, Black Monday.
Black Monday.
Armstrong explicitly predicted a major crash for the window right around October 1987. And then on October 19th, the Dow dropped 22.6% in a single day.
And what was the mechanism he cited was the cause?
It was a failure of government confidence, specifically the failure of the G7's Louvre Accord.
Remind us what the Louvre Accord was trying to do.
It was this big attempt by the world's major economies to cooperatively manage currency exchange rates to try and stabilize the dollar. Armstrong's argument was that this artificial attempt by governments to control capital flows would fail spectacularly.
Because capital would just reject that control.
Exactly. He argued the crash was capital itself rejecting government intervention. So even if skeptics want to quibble about predicting the exact day, predicting a major structural crash in that specific month was, frankly, remarkable, especially since the market had been hitting new highs just before. Our verdict: valid and remarkable.
And the cycle wasn't just working in the U.S. Let's look at the 1989 Japanese top.
Another exact hit. I mean, in the late 80s, the consensus view was that Japan was taking over the world. They were going to replace the U.S. as the economic superpower.
I remember people saying the grounds of the Imperial Palace in Tokyo were worth more than all of California.
That was the level of mania. But Armstrong's model was tracking these unsustainable capital flows into the yen, into Japanese stocks, into real estate, and it predicted the bubble peak. The Nikkei hit its all-time high on December 29, 1989, and then began a collapse that has lasted for decades. The model completely defied a very powerful consensus view.
And finally, let's talk about the 1998 global capital crisis, which I think really validates the whole global flow premise.
It's the perfect test case. Armstrong predicted the Russian financial collapse. And when Russia defaulted on its domestic debt in August 1998, it triggered this massive global panic.
But why did a Russian default matter so much to the U.S.?
Because of a huge, highly leveraged U.S. hedge fund called Long-Term Capital Management, or LTCM.
Run by Nobel laureates.
Exactly, the smartest guys in the room.
Yeah.
And they had a massive leveraged trades based on Russian bonds. When Russia defaulted, LTCM collapsed spectacularly, and it was so interconnected that it required a massive $3.6 billion Federal Reserve coordinated bailout to prevent it from taking down the entire U.S. financial system.
So the Russian default was the event in Moscow, but the consequence, the capital flow, was a systemic failure in Connecticut and New York.
Precisely. It proved that capital truly does behave like energy, transferring instability across borders in an instant. The cycle and the Socrates capital flow analysis worked in perfect sync. Verdict: valid. So the regression test, it really demonstrates that the 8.6-year cycle aligns with these huge structural, economic, and fiscal turning points across 3 centuries. The hit rate is just significantly better than chance.
Okay, here's where it gets really interesting. We've just laid out a case that this analytical framework, the math of the cycle, and its historical application have a staggeringly impressive track record. But to give a complete picture, we have to pivot. We have to address the massive elephant in the room, the legal controversy that just engulfed Martin Armstrong and his firm, Princeton Economics.
Absolutely. We have to dissect this credibility paradox. On one hand, you have a model with powerful predictive utility. On the other, you have a man whose personal reputation and business ethics are, to put it mildly, severely compromised by the collapse of his firm in the early 2000s.
So in 1999, the U.S. government brings charges. What exactly were the allegations? What was the deal with these Princeton notes?
The core allegation was a very sophisticated, Ponzi-like scheme that involved commingling client funds. Armstrong's firm was selling these proprietary investment vehicles, the Princeton notes, mostly to wealthy Japanese investors, and they were promising very high returns.
Okay.
Prosecutors claimed he was taking these client funds, mixing them with his own corporate operating capital, and this is the critical part, covering up massive trading losses. They said he was grossly overstating the value of these notes by hundreds of millions of dollars just to keep the scheme going.
And what was the result of those allegations?
In 2006, after a long legal battle, Armstrong pleaded guilty to 1 count of conspiracy to commit securities fraud. He ended up serving 11 years in prison.
But the length of that sentence is often misunderstood, isn't it? He wasn't convicted and sentenced to 11 years for that 1 count. A huge chunk of that time was served for something else entirely, civil contempt.
That's right. 7 years, in fact, which is reportedly the longest civil contempt imprisonment in U.S. history. That fact alone demands that we look closer.
So what's the difference? Why was he held in contempt for so long?
Well, civil contempt is different from a criminal sentence. He was jailed for refusing a court order to turn over assets, funds, gold bars, antiquities, which the court believed belonged to the investors. He claimed he didn't have them, that they didn't exist. The court basically said, "We're holding you in jail until you comply," viewing his refusal as a direct defiance of his authority.
And this is where the narrative just splits violently. The prosecution and the victims see a guilty plea and a man stubbornly refusing to return stolen assets. But Armstrong and his supporters, they offer a very different story, a conspiracy counter-narrative.
Right. And the counter-narrative, which is compelling to his followers, is that the whole prosecution was weaponized. They claim that the U.S. government, maybe specific intelligence agencies, wanted to get their hands on the proprietary source code for the Socrates system.
Because its accuracy, like in predicting the 1998 LTCM crisis, made it a potential national security threat to the establishment.
That's the argument. They say the charges were basically manufactured to seize the code, and his refusal to turn over assets was actually an act of principled resistance against government overreach.
So how do we, in an independent deep dive, reconcile this? An undeniable conviction for securities fraud on one side, and an undeniably accurate track record of prediction on the other. How should you, the listener, even begin to handle this paradox?
It requires some really rigorous critical thinking. We have to, as we said at the start, separate the man from the method.
Okay, let's start with the skeptical view. Why should we just discount the entire model because of his legal history?
The skeptical view is straightforward. It holds that a willingness to fabricate client financial statements strongly implies a willingness to fabricate or, retrospectively massage the historical cycle hits to make them look perfect.
The argument being that since Socrates is a black box, we can't verify it independently.
Exactly. It allows for sophisticated curve fitting after the fact to make the math look good. This view basically says the legal history taints the entire endeavor, so we should just dismiss it out of hand.
That's a powerful argument. What's the counter? What does the empirical view argue?
The empirical view argues that the data speaks for itself, regardless of his personal ethics. We just went through a regression test against 300 years of history, and the cycle nodes hold up structurally. But more importantly, the biggest, most famous calls, 1987, 1989, 1998, they were all documented and widely disseminated before his legal troubles even began in 1999.
So those ex-ante validations, they prove that the mathematical framework itself had powerful predictive capacity, completely independent of whatever happened with his business later.
That's the core of it. The existence of the 8.6-year cycle and how it corresponds with major financial breaks, that stands on its own, separate from his ethically compromised business decisions.
So the bottom line is, the core math and the capital flow thesis seem to be validated by the historical results, but anything coming directly from the source has to be treated with maximum caution.
That is the essential conclusion. You have to view the ECM as a data point, as a potent risk management framework that you should independently verify, not as, the unquestionable gospel from a flawless prophet.
With that really complex background established, let's bring the cycle into the present. Armstrong's model asserted that the current 8.6-year downward cycle began in January 2020, and it's scheduled to run until the next major bottom in 2028.
And the validation for that starting date is, it's immediate and profound. Now, obviously, no model predicted the specific emergence of a novel virus, but the event that coincided perfectly with January 2020 was the onset of the global COVID-19 pandemic,
which led to the largest, most sudden, synchronized global economic shutdown in modern history.
It was an immediate, massive shock to confidence. It forced radical, unprecedented fiscal and monetary stimulus all over the world. It fits the definition of a major structural disruption perfectly. It was the end of one era, the post-2008 era of QE and zero interest rates, and the beginning of a completely new, high-debt interventionist paradigm. So, verdict, high correlation.
Okay, but this brings us to what feels like a paradox. Let's call it the inflationary downward cycle paradox. We're supposedly in a downward confidence cycle, but here we are in 2024, and the S&P 500, other global indexes, they're hitting sustained record highs. How can a massive stock market boom possibly be reconciled with a model that's predicting declining confidence?
This is the key nuance of the ECM. It's the primary reason that mainstream economists, I think, often misunderstand or dismiss it. The model tracks economic confidence, but it primarily defines that as confidence in government.
So confidence in the government's ability to maintain the value of its currency and to service its debts.
Precisely. And when confidence in government lapses, because debt is too high or money printing is out of control, capital has to execute the flow thesis. It has to go somewhere. It flees public assets.
Like government bonds, cash in the bank, unfunded liabilities like pensions.
Right. It flees those and it floods into private productive assets, stocks, real estate, commodities, gold.
So the stock market boom isn't a sign of economic health. It's actually a sign of panic. It's capital literally running away from money that's being debased, a flight to tangibles to preserve purchasing power.
You've got it. The nominal increase in stock prices is just the mechanism of currency debasement. It takes more dollars to buy the exact same fraction of a company, and the data from the last few years completely validates this structural flight.
Let's look at that data. First, the event that almost no one talks about, the bond market crash of 2022.
That event was arguably a much larger financial crisis than any of the stock market volatility. Long-term U.S. Treasuries, the supposed safest asset on Earth, they suffered their worst year in history. They lost between 40 and 50% of their value in real terms. That is a catastrophic collapse of confidence in sovereign debt.
Meanwhile, inflation spiked to 9.1% CPI, just crushing the real wages of anyone holding cash.
And critically, look at gold. It soared, hitting multiple record highs well over $2,400 an ounce. Gold is the classic flight mechanism when trust in the fiat monetary system is lost. So the model correctly identified this strange stagflationary dynamic. Overall growth is sluggish, but asset values are soaring because of capital displacement and currency debasement.
I think this is a crucial place for anyone listening to pause and just assess their own risk exposure, especially when you're talking about asset valuation. To track the total market temperature, you might find it really useful to search and download the iOS app Buffett Indicator from the Apple App Store.
Oh, right. The market cap to GDP ratio? Exactly. It's an essential quick check tool for tracking market valuations and just the general bubble status in real time. It's exactly the kind of context you need when you're looking at asset inflation being driven by a collapse in confidence. It's a good way to stay grounded. Just search for Buffett Indicator on the App Store.
That kind of external valuation context is essential because the ECM shows that even if the nominal stock market looks healthy, the underlying system is experiencing severe structural stress, making risk management paramount. This model identified a fundamental shift that linear growth models just completely missed. Our verdict. Valid nuance.
Now let's address a critique, specifically around precision. The model listed May 7, 2024 as a key internal turning point, a pivot date.
Right. And what actually happened around that date? Well, we saw increased geopolitical tension, military escalation in Gaza and Rafah, some diplomatic ruptures, but we did not see a 20% stock market crash. The market, fueled by that tech concentration, stayed relatively resilient, which feeds that skeptical argument that the to-the-day precision is often exaggerated, and these minor pivots don't always have a systemic global effect.
And that's a fair critique. Compared to the massive structural turns like 1987 or 1932 or 2020, these daily pivots are often much more subtle. They might mark the turning point in a specific currency pair or a commodity rotation, or maybe just the peak momentum of a single hot sector, like AI stocks.
So users should view them more as windows of high volatility rather than a guaranteed crash date.
Exactly. They are high probability windows where the market direction is most likely to change. But the big picture, that 2028 bottom, that remains the key focus.
Okay, the model has proven historically valid, and it offers a sophisticated, if pretty unsettling, explanation for our current inflationary boom. So now we have to turn to the forecast. If this cycle continues to run true towards its 2028 bottom, the coming decade looks less like a simple correction and more like a fundamental global restructuring.
The ECM projects a three-phase systemic reset, and it all culminates in 2032. This isn't just a forecast of market volatility. It's a forecast of the failure of governance and currency.
Let's break down Phase 1, the sovereign debt crisis, which is forecast for 2025-2027.
The forecast is all predicated on the inevitable collapse of what the model calls public confidence in Western governments. This is expected to lead to a debt crisis that targets the Eurozone first, and then potentially the U.S.
And the structural reality behind this is just terrifying debt saturation. We hear about debt all the time, but what makes this period different? What makes it non-reversible according to the model?
It's the cost of servicing the debt. Global debt is now over $314 trillion. But more acutely, the U.S. government is now paying over $1 trillion a year in interest payments alone.
$1 trillion, just in interest.
Just interest. To put that in perspective, that's more than the entire defense budget. It rivals what we spend on Medicare. It is an impossible structural burden.
Because it means the government has to borrow new money just to pay the interest on the old money.
And that creates the unavoidable debt trap. Interest rates are now structurally higher than they were for the last decade. To pay the interest, governments have to either issue new debt or print money. Printing money fuels inflation, which forces central banks to keep rates high, which then increases the interest payment burden even further. It's a vicious, self-perpetuating doom loop.
So the core prediction for 2025 to 2027 is a failure of the funding mechanism itself.
Yes. The model predicts a failure of confidence. Capital will simply refuse to participate. We should expect to see a major government bond auction fail in a G7 nation or a forced sovereign debt restructuring. It'll likely start in the Eurozone, where the debt governance is more fractured. This failure is the systemic mechanism that has to happen before the cycle can bottom.
And that leads us directly into Phase 2, the cycle bottom and the monetary reset in 2028.
The 8.6-year cycle dictates that 2028 is the point of maximum distortion right after that debt crisis, and therefore it's the mandated moment for systemic resolution. And the implication here is just enormous.
Yeah.
This is the likely end of the post-1971 global fiat monetary system.
The system where currency is backed only by faith in the government. That system will collapse because of the debt trap. So what kind of structural reform does the ECM associate with a crisis of this magnitude? We saw the New Deal back in 1932.
The current discussion is focused very heavily on central bank digital currencies, or CBDCs. The source material suggests that 2028 could mark the official global introduction of CBDCs as the main tool used by states to restructure, manage, or effectively reset that crippling debt load.
And the CBDC would give them much more control.
Complete control. It allows for things like negative interest rates or even expiration dates on currency, things that are impossible with physical cash. It represents a complete paradigm shift in the governance of money.
The bottom of the cycle is always followed by radical centralization and restructuring.
Always. The crisis forces the hand of governments. It makes them adopt radical measures they would never dare consider in normal times.
And that brings us to the final phase. Phase 3, the war cycle peak and empire shift, right around 2032.
This is the convergence point. The 8.6-year cycle aligns with the longer 51.6-year wave, and that suggests a crisis of empire. The model predicts that a major global conflict will peak around 2032.
What's the driver of this conflict? Is it just geopolitical rivalry, or is it tied back to that economic collapse in Phase 1?
It's intrinsically linked. The ECM predicts massive civil unrest and social discord in the West. peaking around 2026. This is driven by economic pain, the failure of the social contract, and historically, what do governments do when they face internal collapse? They manufacture foreign enemies.
Distract the populace, consolidate power, and justify war spending.
Exactly. Now, the predicted nature of this conflict isn't necessarily traditional warfare. Armstrong specifies a hybrid war.
So heavy use of economic sanctions, cyber attacks, currency manipulation, proxy battles.
All of that, which could ultimately culminate in kinetic conflict as global alliances fracture. And this is all tied to that supercycle timing. If the United States was established in 1776, it approaches the end of its 256-year political cycle right around 2032.
So that's the alignment. The convergence of cycles suggests this marks the end of the U.S. as the undisputed global financial hegemon.
That's the prediction. The geopolitical outcome post-2032 is the inevitable shift of the world's financial capital, the center of gravity for global money away from the West and towards Asia, specifically centers like China or Hong Kong, following the failure of the Western sovereign debt systems.
So if this framework holds, what's the most critical, actionable intelligence for the listener right now? Specifically for that volatile period between 2025 and 2028, when this debt crisis is supposed to hit, what does the capital flow thesis demand we do?
The strategy has to be driven by that core principle. Capital flees government promises. If government debt is unpayable, then any asset that is based on those promises becomes the highest risk.
So what does that mean in practical terms?
It means that tangible assets and productive equities are expected to continue to dramatically outperform government bonds and fiat cash. The market might be volatile, but the nominal prices of real things, land, infrastructure, productive companies, will likely continue to rise as the underlying currency devalues.
So the goal is to minimize your exposure to anything that relies on a government's promise to pay you back, or a bank's promise of solvency.
Precisely. Armstrong's advice on this is simple. Minimize exposure to unpayable government liabilities, particularly things like pensions and long-term government bonds, and critically, hold assets outside the traditional banking system. That means direct ownership of real assets, commodities, and physical precious metals like gold. Those are the safe harbors capital will seek when the sovereign debt trap finally slams shut.
This has been an incredibly exhaustive deep dive into Martin Armstrong's economic confidence model. It is, without a doubt, a controversial theory, but it's one whose historical performance really demands serious consideration. So let's quickly summarize our forensic verdict on the Chi cycle's validity.
Okay, first, the 8.6-year cycle appears to be statistically valid for tracking the juggler business cycle and these major systemic liquidity crises. The regression test against 3 centuries, 1907, 1932, 1987, 2020, it yields a structural hit rate that is far, far better than mere chance.
Second, the model is highly effective at identifying structural shifts. Its unique focus on capital flow correctly predicted that strange stagflationary dynamic we saw in 2021 to 2023, seeing the stock market rally not as a sign of health, but as capital fleeing a collapse in confidence in government fiat. That's an insight that linear models just completely missed.
And finally, the 2032 forecast, as dramatic as it sounds, is a highly plausible projection of trends we can already see in verified debt saturation, geopolitical fragmentation, the cost of currency debasement. It's just mapping those verifiable trends onto an established, recurring, temporal timeline.
So the final recommendation really stands. The economic confidence model should be viewed as a powerful, mathematically derived risk management framework. It's one that provides a crucial warning about the timing and the nature of an impending systemic failure.
And if we connect this to the bigger picture, the certainty that the model provides suggests the world isn't just entering a period of, economic slowdown. It suggests we're moving from the relative peace and stability of the post-Cold War era into a highly volatile winter of debt deleveraging, geopolitical conflict, and currency restructuring. The decisions made by individuals, by you, and by governments between now and 2032 will likely define the financial and geopolitical structure for the rest of the 21st century.
Which leaves us with a final provocative thought for you to mull over.
Yeah.
If the oscillation of our collective human confidence truly does adhere to a fixed frequency derived from a natural constant like pi, what other forces, maybe the base of the natural logarithm or the golden ratio, what other constants might be secretly governing other fundamental aspects of our behavior, whether it's in politics and technological adoption cycles or even in mass culture?
Until next time.